Doyle and welcome to Livewire's 100 Top Rated Fund series. I'm your host, James Marley, and I'm here with Simon Doyle, who's Head of Fixed Income and Multi-Asset at Schroders. Simon, great to have you here.
Hi James, nice to be here.
Yeah, cracking afternoon. You're one of the most experienced investors in the Australian market. You're a bit of a legend. I know a lot of people love following your multi-asset strategy, but each day you've got to get up and do it again. What's the thing that motivates you?
Well, it just, I guess, makes me sound old and been around for a while, but I guess, there's an element of experience in that. But I think, I guess one thing that's important to me is just integrity and making sure that each day I'm doing the right thing and trying to do what we say on the tin for our clients. And I think if we can do that, we won't always make everyone happy every day, but I think over time that will end up adding up to some pretty good results. So I think that integrity, I think, is very important to me.
Yeah, I'm not going to labour on the years and decades of market experience, but I was hoping you could maybe think back over your career and maybe pinpoint one or two events or people that have really helped to shape the way you think about investing.
Well, in terms of people, I guess I'd probably go back to high school, and I was lucky in a way to be going through year 11 and 12 economics in sort of 1983, 1984, which was a time of huge deregulation in the Australian economy. And so, we were very inspiring teacher, and we sort of spent a lot of time thinking about the floating of the dollar and deregulation and all those sorts of things. So that gave me a real desire to work, I guess, in financial markets. I didn't really know that much about funds management at the time, but it sort of set me on this path. Then I think in terms of my career, it's really been about, I started work 4 weeks after the '87 crash. I was given the job of forecasting bond yields about sort of 8 or 9 months before the bond market crashed. I remember going around the country trying to sort of promote a technology fund for AMP in early 2000, and we launched our real return strategy in October 2008. So I think, I guess that those experiences of kind of market crises, I think, have been, very important in terms of kind of shaping the sort of investor I guess I am.
Do you feel like you're better at handling the crises now?
Well, I think you don't. I guess one of the challenges today is, we haven't central banks don't allow crises to really, develop and go on for too long. And I think you don't really understand risk. You don't really understand investor behaviour until you're kind of in the middle of a crisis and you're trying to manage money in the middle of a crisis. And, I often say to kind of my team that, experience is just that, it's experience. And in financial markets, the bits you remember, the really bad, the really tough days. When markets are just sort of running on normally, you tend to forget those. So, I think it is really important in terms of sort of developing your understanding of your philosophy of risk and, how your clients behave and what they actually expect from you.
Take me inside the room. What are you and your team focused on at the moment? What are you spending the most time debating?
Well, there's a couple of things that sort of, I guess, focus our mind. I think one is the sort of the policy environment. So we're in this world where, in a way, markets are happy. Economies, in some ways are happy because central banks and governments have sort of thrown the kitchen sink at them, and that's helped support economies, which is good, and it's also kind of pushed asset prices up. And I think most asset prices have all moved in the right direction. So that high degree of correlation in sort of market performance, that sort of relatively elevated valuation across every asset you look at, including things like house prices in Sydney, for example, is a challenge, and thinking about how we're going to make money going forward. And I think the other sort of side of that is, well, what causes this to break? And I guess one of the things most people are thinking about at the moment is inflation. With this sort of massive injection of liquidity into economies, into financial markets, you're starting to see kind of supply chains or problems in supply chains and so on, that if we get inflation, then this very positive environment we've enjoyed in asset pricing could come unstuck. And I think that's taking a lot of our focus at the moment.
And how is that flowing through to where the rubber hits the road in terms of what you're putting into your portfolios and how you're shaping them?
Well, yeah, I guess ultimately it sort of comes down to what do we do about that. We can talk about it and we can analyse it, but we've got to do something. And I guess, it comes back to kind of underlying beliefs. And one is, we do think valuations are important. They're not always important every day, but they do shape returns in the medium to long run. They tell us a lot about risk, and that's telling us, we probably do need to be a bit cautious. It's also, I think when we think about, well, how do we hedge that risk in portfolios, the fact that bond yields are very low, interest rates are very low, does complicate things because, bonds as a diversifier are likely to be less effective and could actually be the cause of the problem. So, we're looking at sort of strategies we can employ to manage that risk. And part of that is not taking too much risk in the first place, and we don't have to worry about hedging it. But another element of that is looking at things like currency, looking at options, looking at sort of diversifying strategies that can help sort of manage that overall risk. So we want to still participate, but we don't want to be too exposed if something goes wrong.
Mm. You run multi-asset portfolios. I'll put a question to you that I've been asking some of the researchers today. Is there an asset class that you think is underappreciated or underrepresented in portfolios that you think has a really important role to serve going forward from this point?
Where we're looking is in areas of, I guess trying to go broader and deeper. So pulling apart sort of the broader indices and say looking, within the global bond universe to say, well, which parts of that are actually better value? Let's not just own, the entirety. Let's really carve out the pieces that we think are value. And, some of the more interesting things in that for us, things like Asian credit, for example. Other areas which I think are of interest are, I guess private markets. I think there's a lot of, the easy money's flowed into public markets, but there are sort of pockets of sort of private markets where there's a risk premium, so investors can use their liquidity budget, if you like, to kind of capture some of that additional risk premium. So I think, institutional investor portfolios are probably relatively well exposed to some of those themes, particularly on the private side. But individual kind of retail investors, I think, have still got some scope to move when it comes to private markets.
Yeah, interesting. If we're to use a simple framework for thinking about market cycles, moving from skepticism or pessimism, where we were 12 months ago, through to skepticism, optimism and euphoria, where would you peg us as being right now? Yeah,
it's not a normal cycle. I think if you look at the market cycle in terms of what's priced into asset markets, you say you're pretty late cycle. You're kind of somewhere close to, you maybe not euphoria, but you're sort of heading up on that end of the spectrum. I think if you look at the economic cycle, you're probably further back. And I think that the fact that the economic cycle has still got more to run is something that's kind of supporting the market cycle. So, I guess it's hard to kind of say we're exactly here because it is a very unusual cycle.
Is there a long-term trend or a theme that is playing out through the markets that you think represents an interesting opportunity for investors at the moment?
Some of the things which I think are now starting to, become important are, I think this sort of broader idea of rebalancing, and we're seeing it in terms of sort of geopolitics, US, China, and how and where that plays out. We sort of moving into a world of deglobalisation, which could be problematic for inflation and a kind of a realignment of sort of the geopolitical sort of power alignment. And I think the inequality story is playing out as well, and that's I think likely to flow through into sort of policy settings and so on, in terms of sort of taxation and so forth. So I think there's this very positive short-term story, but I think there's a number of sort of fairly powerful longer-term sort of structural thematics that I think will have a big impact over the next decade.
And are there any specific ways that you are catering for that from an investment perspective, or that you're factoring it into the portfolios?
Well, I think one thing is we shouldn't underestimate risk. When you've got fully priced markets, it's all great until something goes wrong. So I think the risks are starting to skew a bit to the downside. So I guess that's probably one point. I mean, another is in an environment where central banks have really almost backed themselves into a corner around how they can operate monetary policy, then I think currency markets could be an interesting space where some of the pressure of these factors will sort of play out.
You alluded earlier about the challenge that bonds may present from a defensive part. Have you found an effective way to maybe mitigate some of that, or an alternative? How have you thought about that challenge?
Well, that's I think one of the key kind of conundrums for investors, and I think there's a couple of ways to think about it. I mean, one is, I think if you can't hedge something, then hold less of the thing that you're trying to hedge.
Yep.
Right. So, bonds are less effective at hedging equity risk, then hold less equities. Right, if you're concerned about valuation, and so I think that's the most powerful strategy you've got. If you look at currency markets, I still think the US dollar goes up when equity markets go down. That's a pretty reliable relationship. So not necessarily thinking of currency as a return driver, but as a risk hedge. Mm-hmm. And I think you're seeing a bit more, in terms of sort of outright protection sort of coming through things like the option market. And I think substituting some of that equity risk for, maybe higher yielding sort of debt type investments, which aren't as risky as equities, but offer you a bit more sort of carry than sort of traditional fixed income assets. So I think it's a bit of a multi-pronged approach, but at the core is, managing your overall level of risk in the portfolio. Then you don't have to worry as much about hedging it.
Yeah. Final question for you. From all your experiences as an investor, if there was a single piece of advice that you could offer to people to help them be more successful, what would that be?
Well, I guess one thing I've learned over years is, if your objective is to do a certain thing, focus on doing that. If you're looking to achieve a particular rate of return, build a portfolio that does that. Don't worry about what everyone else is doing. Don't worry about sort of missing out on something that was better. If you're achieving through the strategy you implement what you've actually set out to achieve to meet your goals, then I think that will deliver you the best results over the long run.
Simon, thanks very much for coming in today. Thanks for being part of our top-rated fund series.
It's a pleasure. Thanks for having me.